decoding the $100,000 Bitcoin, the real secret behind crypto prices, and why Pi Network could be a game changer. Part 1. The $100,000 question. Why are crypto prices so high? Bitcoin over $100,000. Ethereum breaking the $4,800 mark. Have you ever stopped and wondered how? How can these lines of digital code, these lines on a screen, reach such insane prices? What makes someone, somewhere, willing to pay the price of a house, or even more, for a single Bitcoin? As we've seen, Bitcoin peaked above $100,000, while ETH was at $4,800. Do you wonder why people are willing to pay such unbelievable prices for these cryptocurrencies? This is precisely the core question that many of us are grappling with. Is this just hype, a bubble waiting to burst, or is there something deeper, something fundamental driving these valuations for these specific coins, while thousands of others are languishing in obscurity? What if I told you the answer lies not just in technology, speed, or even features, but in something more fundamental, something related to control? And what if I told you that a project you might have joined or heard of, Pi Network, is being built with that very fundamental principle in mind? Could it hold the key to unlocking similar long-term value? Join me throughout this video as we take a deep dive. We'll unravel the mystery behind crypto's highest prices, expose a serious vulnerability in many popular projects, and explore why Pi Network might be positioned to follow in the footsteps of the giants. You definitely won't want to miss this. Part 2. The danger lurking beneath the surface. Centralization in crypto. So not all cryptocurrencies reach those dizzying heights. Why is that? Let's look beyond the surface hype and consider the structure of some popular coins. Take BNB, the powerful coin behind the Binance exchange. For example, CZ, the head of Binance, holds up to 94 million BNB. This amounts to 64% of the 147.5 million BNB in circulation. Now, think about that. 64%. Imagine you're playing a board game where one player owns 64% of all the assets and money right from the start. How fair does that feel? How much control do they have over the outcome of the game? It's like building your dream home, not on solid ground you own, but in a sandbox where the owner holds the majority of the sand and can change the rules anytime. This precisely reflects the saying, if you build your house on BNB chainland, where CZ owns up to 64%. That's an uncertainty for small retail investors. Perhaps this doesn't seem like a big deal, but what about large corporations, institutions, or wealthy individuals? The whales who move the market. Would you invest millions, even billions of dollars, into an asset where a single individual or entity holds such overwhelming control? The risk of manipulation, sudden rule changes, or decisions that benefit the majority holder rather than the network is simply too high. The risk is not just that CZWLL manipulate BNB. It is the very perception of that possibility. Large, conservative investors always prioritize risk mitigation, even if CZ acts benignly. The structural vulnerability created by such concentrated ownership is a red flag preventing significant long-term institutional capital from flowing in. Compared to more decentralized alternatives, it creates uncertainty. A single entity having control of over 51%, let alone 64%, introduces a massive single point of failure in centralized control, significantly increasing the perceived risk, even if that control is never abused. This perceived risk is a powerful deterrent. Now let's look at Cardano Ether. The top 5 addresses holding the most Ether on Cardano are not publicly labeled. We know exchanges like Binance hold a lot, but they're not even in the top 5. This lack of transparency about the identity of these biggest players creates uncertainty. Why is this important? In crypto, transparency is often linked to trust. If you don't know who holds power, How can you assess the risk of collusion or large-scale sell-offs? It's like investing in a company without knowing who sits on the board or who the major shareholders are. The lack of transparency in large holdings isn't just about hiding identities. It prevents the broader community and potential large investors from conducting crucial on-chain analysis. They cannot effectively track whale movements, accumulation, distribution patterns, or potential collusion risks. This information asymmetry erodes trust compared to more transparent systems. Why is labeling transparency important? It allows anyone to follow the money flow, identify key players, exchanges, funds, funders, and assess potential market impacts. Without it, the market operates with less information, increasing the perceived risk for those who rely on such analysis, often larger investors. It feels less like an open system. So, we see two sides of the same coin here. High ownership concentration (BNB) and lack of transparency regarding large holders (Ether) both lead to the same fundamental problem, a lack of true decentralization. And this, according to the argument we're exploring, is a major barrier to attracting the kind of serious, long-term capital needed to reach valuations at the level of Bitcoin or Ethereum. As stated, BNB and Ether both have very high concentration. It's not publicly transparent. This is the main reason why BTC and ETH prices can reach such high levels. It's precisely because the big money players are only willing to buy these two coins. Part 3. The foundation of trust. Why Bitcoin and Ethereum attract billions. So, if centralization and lack of transparency are deterrents, what's the alternative? Let's turn to the kings, Bitcoin and Ethereum. Why are the big money players seemingly comfortable pouring billions of dollars into BTC and ETH? Decentralization. Unlike BNB or Ether, ownership of Bitcoin and Ethereum is widely distributed, diluted across millions of holders worldwide. What does diluted mean here? It means no single entity, no single founder, no single company holds a majority of the control. Satoshi Nakamoto, Bitcoin's anonymous creator, disappeared. Vitalik Buterin and the Ethereum Foundation hold a significant amount of it, but nowhere near a controlling stake of the circulating supply used to network consensus. Power is dispersed. This distribution is incredibly important. It means no single point of failure, The network doesn't depend on one person or company. Censorship resistance. Extremely difficult for any single entity to block transactions or change the rules. Predictability. The network's rules monetary policy. Transaction validation are often fixed or only changed through broad consensus, not by decree. Transparency. Transactions and holdings the pseudonymous are on a public ledger. Anyone can verify the state of the network. For a multi-million or multi-billion-dollar investor, this translates into mitigated risk. They can trust to a much higher degree that the asset won't be easily manipulated, seized, or fundamentally altered by a central authority. This trust, built on decentralization, is presented as the reason why they are willing to invest so heavily, driving up prices and market caps, while sometimes slower or harder to upgrade. The perceived decentralization of BTC and ETH is not a bug. It's presented here as their core feature from an investment security perspective. It's the trade-off to achieve digital scarcity and trust without a central intermediary. This inherent structure is what attracts capital-seeking resilience rather than centralized efficiency. The original text contrasts the success of BTC, ETH with the centralization of BNB, Ether. It explicitly links the high price of BTC, ETH to big money buying them due to decentralization. Why is decentralization attractive to big money? Because it mitigates counterparty risk and the risk of arbitrary changes. These features are highly valued for large-scale, long-term investment. Part 4. The ecosystem battle. Building sustainable empires versus fleeting trends, decentralization isn't just about attracting large investors. It has a profound impact on what gets built on top of these blockchains, the ecosystem. Let's compare the ecosystems of Ethereum and BNB chain. As the original text suggests, on Ethereum, we see foundational projects, pillars of decentralized finance, DeFi, and Web3. Think of Uniswap, a leading decentralized exchange, Chainlink providing crucial real-world data, or even groundbreaking games like Axie Infinity that gain significant traction. Why do serious developers often choose platforms like Ethereum despite sometimes high fees? Because building a complex, potentially multi-million-dollar DApp decentralized application requires a long-term commitment. Developers need assurance that the underlying platform is stable, censorship-resistant, and won't suddenly change direction based on the whim of a single controlling entity. True decentralization provides that assurance. Now, let's look at BNB chain. While it has its successes and lower fees attracting users, it's also known for meme coins that pump and dump, and countless play-to-earn games, with short life cycles designed primarily for quick token sales. Building on BNB chain is like building on land where CZ owns 64%. You might build a temporary structure, trying to make quick profits riding the wave of FOMO. But would you build a sustainable castle long-term, sell a castle on someone else's land where they hold ultimate control? Probably not. Truly decentralized platforms are often permissionless. Developers don't need approval from a central entity to build. This fosters a more chaotic, but ultimately richer and more diverse ecosystem, as anyone can experiment. While this includes scams, it also allows for groundbreaking innovations that might be stifled on more controlled platforms. Quality emerges from quantity and freedom. So, the degree of decentralization directly impacts the type and sustainability of the ecosystem built upon it. Truly decentralized platforms, like Bitcoin as a store of value and Ethereum as a smart contract platform, attract not just big money, but also developers committed to building the future. Part 5. The emergence of a third force. Could Pi Network be the successor? For years, the crypto world has largely seen Bitcoin and Ethereum as the undisputed champions of decentralization. Many have tried to replicate their success, often failing, ultimately becoming more centralized than intended. But what if a third contender has been quietly building, learning from the past, and aiming for that same level of true decentralization from day one? This brings us to Pi Network. Token distribution. The project development team will hold a maximum of only 20% of the total amount of Picoin, while the community will hold 80% of Picoin. Explicitly contrast this with BNB's 64%. This 80-20 split is specifically designed to ensure the community holds the overwhelming majority, preventing the type of centralized control seen elsewhere. Transparency. Furthermore, transparency tools like Piscan.io or similar official explorers are available. You can use these tools to see which wallets hold Pi, including identifying the largest holders, ensuring public visibility. Contrast this with the lack of transparency mentioned for ADA's top wallets. Do you see the connection? The wide distribution that the 80-20 split aims for reflects the diluted ownership allotted in Bitcoin and Ethereum. The public visibility of holdings by blockchain explorers mirrors the transparency valued in those networks. Pi Network appears deliberately designed to address the very centralization concerns plaguing other projects. Bitcoin's decentralization was largely organic. Satoshi disappeared. Early miners were dispersed. Ethereum's decentralization evolved. Pi Network's decentralization is being designed from the ground up. Tokenomics. No distribution goals. This is both a strength learning from the past and a challenge needs to prove it works in practice and resists centralizing pressures over time, especially before mainnet launch and during initial growth. Will the design stand up to real-world economic and social pressures? Can it truly prevent eventual centralization? Pi Network, at least in terms of design, is attempting to position itself alongside Bitcoin and Ethereum in terms of ownership distribution and transparent. Why? Sharply contrasting with the more centralized or less transparent models seen in Part 6, P's path forward, potential, price, and patience. Okay, so Pi Network is designed for decentralization, but what does that really mean for its future potential and price? Because Pi Network is structured to be truly decentralized and transparent, like Bitcoin and Ethereum, it is expected to eventually attract the same kind of serious investment. Corporations, institutions, and whales who have avoided BNB rate due to control risks will see Pi as a viable alternative for significant long-term investment. And just like with Ethereum, this decentralized platform is expected to attract developers to build robust, long-term applications. They'll choose Pi because they can trust the platform's neutrality and longevity. Now, let's talk about price. We see wild predictions online. The original text itself makes a quick, rather funny comparison. If Pi reached Ethereum's market cap, one Pi could be $2.16. If it reached Bitcoin scale, maybe $20. Pi coin reaching $1,000 or hundreds of thousands of dollars is unrealistic. The real potential isn't about hitting the jackpot overnight. It's about the inevitability of attracting serious capital and developers because of its decentralized foundation. Just as BTC and ETH have done, value comes from utility, adoption, and trust. Price follows that. Don't think Pi will be worth as much as BTC, ETH, but understand that Pi will have value because it shares the fundamental decentralized characteristic that made BTC, ETH valuable to large investors and builders. It's about replicating the cause decentralization, attracting trust and development, not just predicting the effect high price. Building something truly valuable and decentralized takes time. Bitcoin took years to gain traction. Ethereum's ecosystem has evolved over many years. Pi Network is still in a relatively early stage, especially regarding open mainnet and ecosystem maturity. Patience and continued participation are key. Part 7. The future is decentralized. Your role in the next wave. So, what have we learned today? We started by asking why Bitcoin and Ethereum have such high prices. We've explored the argument that the answer lies not just in technology, but in trust, built on the foundation of true decentralization. We've seen how perceived centralization and lack of transparency in other projects like BNB and Ether can deter serious, long-term investment and potentially limit ecosystem growth. And we've looked at how Pi Network is being intentionally designed with wide token distribution and transparency to achieve the same level of decentralization seen in BTC and ETH. As a potential third wave, understanding this fundamental difference, the power of decentralization, is key to navigating the crypto space. It helps you look beyond the hype and evaluate projects based on their core structure and long-term potential. If you're a pioneer, this understanding reinforces the potential significance of the project you're part of. Keep engaging, secure your Pi, participate in the ecosystem, and contribute to the network's growth. Your role is crucial. If you're new to Pi or crypto, hopefully, this deep dive has given you a new lens through which to evaluate projects. Look for the fundamentals, especially decentralization, when considering where the future might be headed. The journey is long, but the potential, built on the right foundation, is immense. Good luck, pioneers!